Everyone knows VOO and SPY, the big index funds that track the S&P 500 and crush it over the long run. But what if I told you there are 5 ETFs that have actually beaten them by 10 to 15% per year, and most investors have no idea they exist? These aren't the usual index funds you hear about. They use smarter strategies, higher income plays, and a few unique structures that let you build wealth faster if you use them the right way. Now, I've been investing for years. I manage a $300,000 plus portfolio focused on long-term growth and consistent returns. And over that time, I've tested a lot of ETFs. Some of them were great, some not so much. So in this video, I want to break down the ones that actually move the needle. We're not just talking about what to buy. We'll go through how much to allocate, when these funds perform best, and why they've managed to outperform popular funds. Think of this as a complete strategy, not just a list of tickers. And of course, here's a quick disclaimer before we start. This video isn't financial advice. It's all about education and research, so make sure to do your own due diligence before investing. So first, let's talk about why we even look beyond the popular stuff in the first place. I'm taking VOO, for example, because it's a very common ETF that people invest in. Now, don't get me wrong, VOO is amazing. It's stable, it's efficient, and it's made millions of people rich over time. But here's the catch. It's what I call the diversification trap. See, everyone thinks VOO gives you broad diversification across 500 companies. But the truth is, it's market cap weighted. That means the bigger a company is, the more of your money goes into it. So in reality, about 30% of your entire investment in VOO goes into just 10 megacap stocks, names like Apple, Microsoft, and Nvidia. That's not real diversification. That's more like closet concentration. You think you're spreading your money out evenly, but you're not. You're just loading up on the biggest players. And when those few names stumble, your diversified portfolio takes the hit. Now here's the kicker. Since 2020, growth stocks have outperformed the S&P 500 by around 8% per year. But VOO only gives you about 40% exposure to that growth side. So you're missing a big piece of the action. That's where today's ETFs come in. They tilt your portfolio a little more toward growth and smart income without going full YOLO on risky stuff. So this video is not for everyone. Only watch this if you're comfortable taking on 15 to 20% more volatility in exchange for potentially higher long-term returns. It's not about replacing VOO. It's about complementing it. Think of it like giving your portfolio a performance boost while still keeping that core stability. Okay, now with that said, let's get into the ETFs. ETF number 1, SCHG. Let's start with one that I call the VOO upgrade. Now, this ETF focuses on growth stocks, the companies that are still expanding fast, like tech and innovation name. So why is it an upgrade over VOO? Because it doesn't just copy the S&P 500. It takes the growth side of those companies and gives them more weight. And here's the simple version. VOO owns the entire market. SCHG owns just the faster growing part of it. That's why over time, SCHG tends to beat VOO because it automatically leans toward the winners. It's still market cap weighted, which means your biggest holdings are still companies like Apple, Microsoft, and Nvidia, but within the growth world. Now let's use an example calculation to see how different this is. If you'd invested $10,000 in SCHG back in 2015, you'd have about $38,000 today. The same money in VOO, around $32,000. That's a $6,000 difference, and you didn't have to lift a finger. So when these leaders rally, SCHG rides that wave even harder. And here's something most people don't realize. SCHG is also very tax efficient. Unlike some mutual funds that trigger big capital gains taxes each year, ETFs like SCHG rarely do. So you get that growth with fewer tax headaches. How to use it in your portfolio. If you've got an aggressive growth section in your portfolio, you could make SCHG about 50 to 60% of that bucket. And to balance it out, pair it with a small cap value ETF. That helps reduce risk if tech slows down. But here's the warning. SCHG also drops harder when the market crashes. In 2022, when VOO fell about 20%, SCHG dropped closer to 30%. So it's higher risk, higher reward. Totally fine if you're thinking long term. Before we get to the next one, if you're enjoying this video, make sure to hit that like button and subscribe to the channel if you want to see more videos like this. ETF number 2, SMH. This ETF has been absolutely on fire lately. Now, when people hear semiconductors, they usually just think of chips, but it's much bigger than that. Semiconductors are the foundation of everything tech: phones, data centers, AI, cars, even smart fridges. And here's the exciting part. From 2024 to 2030, experts expect over $1 trillion to be spent building AI infrastructure. That means more chips, more demand, and more growth for this whole sector. That's why SMH has crushed returns. But there's a flip side. Semiconductors are cyclical. They go through big boom and bust cycles. For example, SMH crashed hard in 2018 and again in 2022, both times dropping around 40%. So if you're buying this ETF, the best way to do it is through dollar cost averaging, adding a little regularly, especially when tech stocks pull back. Don't chase it after a 30% rally. What's inside SMH? Yes, you've got the big ones, NVIDIA and TSMC. But here's the cool part. It also holds companies like ASML, which makes the ultra-advanced machines that actually build computer chips. They have a monopoly on this process. No one else in the world does what they do. That's something most investors totally miss. But keep in mind, about 70% of SMH is made up of companies based in Taiwan and the Netherlands. That means if anything happens in those regions, it could shake the ETF in the short term. Portfolio strategy. I'd keep SMH as a satellite holding, meaning not your core, but an extra piece of your portfolio. Limit it to around 10 to 15% of your total investments. And to balance it out, pair it with a bond ETF like BND. That helps smooth out the ride. Tax note. SMH does pay a small dividend, around 0.3%, but it's qualified, which means it's taxed at a lower rate than regular income. Next up, let's talk about something a little different. AOTG, the Aperture Growth ETF. This one isn't a regular index fund. It's actively managed, which means there's a real manager behind it picking stocks instead of just tracking an index. Now, here's what makes AOTG interesting. It focuses on what's called low marginal cost businesses. That sounds fancy, but here's what it means in plain English. These are companies that can add millions of new customers without spending much extra money. Think about companies like Netflix, Google, or Robinhood. Once their platform is built, adding new users doesn't cost them a lot of money. That's how they scale fast and keep profits growing. So what's the edge here? Unlike VOO or other index funds that have to hold every stock in the index, even the bad ones, its manager can dump the losers fast and move into stronger names. That flexibility can make a big difference in fast-changing markets like tech. Now, yes, AOTG has a 0.75% fee, which is higher than index funds, but let's do some quick math. If AOTG beats VOO by 5% per year, even after paying that fee, you're still making about 4.3% more than you would in VOO. So as long as it keeps performing, that cost can be worth it. But here's what you need to know. AOTG is still new, only about 3 years old. It hasn't gone through a full recession yet, so we don't know how it'll hold up in tougher market. Also, since the fund trades stocks often, that's called high turnover, it could create tax drag in regular accounts. So it's smarter to hold this one in a Roth IRA or other tax-sheltered account. Performance check. If you compare it to ARKK, Cathie Wood's famous innovation ETF, AOTG has been a bit steadier and more selective so far. While ARKK chases the next big thing, AOTG focuses more on companies with solid business models and real growth potential, not just hype. But remember, AOTG is still a newer fund, so treat it like a high-conviction bet, but not your entire portfolio. Something like 10 to 15% of your holdings makes sense if you really believe in its strategy. ETF number 4 is QTUM, the Defiance Quantum ETF. This one focuses on companies working on quantum computing, AI, and advanced cloud technology. Now, before you get excited, this is still early stage stuff. Most quantum-related revenue probably won't kick in until 2027 to 2030. So this is a long-term bet, not a quick moneymaker. But here's something a lot of people miss. QTM isn't 100% quantum companies. In fact, about 60% of the fund is made up of regular AI and cloud tech names, like NVIDIA, Google, and IBM. So even though the name sounds futuristic, most of your money is still in real, established companies. It's also well diversified geographically, around 78 different holdings spread across the US, Europe, and Asia. That means you're not overly tied to one region, which helps reduce risk. Now, the reality check. Quantum computing could be the next internet, changing everything. Or it could end up like those 3D printing ETFs from a few years ago that never really took off. So treat this as speculative, not guaranteed, and it's really volatile. In 2022, QTM dropped around 35%, while VOO fell only 18%. Smart way to use it. Keep QTM at about 5 to 10% max of your portfolio. Think of it as your future tech lottery ticket, a small, high-potential bet that could pay off big long-term. All right, the fifth and final ETF on our list, and probably the one everyone's been curious about, is CHAT, the Roundhill Generative AI ETF. Now, there's been a lot of hype around AI lately, but here's the key difference between hype and reality. Not every AI company is actually making money from AI yet. So let's break it down. In CHAT, you'll find big players like Microsoft and Google. These companies are already earning billions from AI tools like Copilot, Bard, and cloud-based AI services. Then you've got the more speculative names, smaller tech firms that might grow later, but they're still in early stages. That's what makes CHAT interesting. It mixes proven AI winners with a few up-and-comers that could take off later. Now, CHAT charges a 0.75% expense ratio, which sounds high compared to regular index funds. But remember, this is an actively managed ETF, meaning experts are handpicking stocks they believe will lead the AI revolution. If they can beat the market by even 2% per year, that fee is totally worth it. One thing to know though, CHAT isn't super diversified. It holds about 42 stocks, but the top 10 make up nearly 65% of the fund. So when those top names move, CHAT moves with them, up or down. Timing also matters here. AI stocks can be really volatile. After a massive 40% run-up in 2023, many of these names dropped around 20% in early 2024. So the smart move is buy on dips, not during hype cycles when everyone's talking about AI on the news. Portfolio fit? If you already own VOO or QQQ, you already have about 15 to 20% AI exposure built in. CHAT is for that extra 10 to 15% conviction when you really believe AI will keep transforming everything. And tax-wise, it's actually pretty efficient. Since CHAT doesn't pay dividends, you won't owe taxes every year. You only pay when you sell. Section 3. How to build your portfolio. All right, we've covered all 5 ETFs. Now, let's talk about the part that most videos skip, how to actually put them together into a balanced, smart portfolio. Because knowing what to buy is only half the battle. The real power comes from how you allocate them based on your goals and risk level. Aggressive investor. If you're young and have time to ride out volatility, this is where you can really lean into growth. 30% in VOO, your safety base, 25% in SCHG, 15% in SMH, 15% in AOTG or CHAT, 10% in CHAT, 5% in QTUM. This is a portfolio built for long-term wealth. It'll swing more in bad years, but historically, higher risk equals higher returns over time. Moderate investor. Balanced approach. You're comfortable with a bit more risk, but you still want a mix of safety and growth. 50% in VOO, 20% in SCHG, 10% in SMH, 10% in AOTG or chat, 5% in QTUM, 5% in an international ETF like VXUS. This setup keeps you diversified with exposure to growth, tech, and the rest of the global market. Conservative investor. If you care more about steady growth and less about volatility, here's one setup. 70% in VOO or SPLG, your solid core for stability, 15% in SCHG for a little extra growth, 10% in BND, a bond ETF to smooth things out, 5% in SMH or chat, just a small tech satellite for upside potential. This gives you a portfolio that grows but doesn't swing wildly every time the market moves. Okay, let's talk about the elephant in the room. Are high fees killing your returns? I know what you're thinking. 0.75% for AOTG and chat? That's 18 times more than VOO's 0.03%. Is this guy crazy? No, you're not crazy. That's a fair question. So let's do the math. Quick note here. I'm assuming the stated annual returns are gross returns and that fees reduce those returns. That's how most people should think about it. So let's see when high fees are kinda worth it. Let's do a clear example. Start with $100,000 for 20 years. Assume VOO gross returns equal 13% per year and its fee is 0.03%. That nets about 12.97% per year. After 20 years, that grows to roughly $1,146,000. Now, assume a higher fee active fund, call it AOTG, with gross returns of 18% and a 0.75% fee. That nets about 17.25% per year. After 20 years, that's roughly $2,411,000. So, even after paying much higher fees, the active fund ends up about $1.26 million more in this example, because the bigger gross return overwhelms the fee. If you want to calculate this yourself, here's a quick rule of thumb you can use. A fund charging 0.75% needs to beat VOO by about 0.72% per year to justify the extra cost. Why 0.72%? Because 0.75% minus 0.03% equals 0.72%. Simple. So if an active ETF really does beat VOO by 1% or more annually, that fee often becomes noise. It's worth it. AOTG has beat VOO by big margins in recent years, which is why people justify the fee. But now the other side. How to spot a ripoff. Here are some red flags. Funds that underperform the S&P. Fees don't fix bad returns. Funds that have almost the same holdings as VOO or QQQ, yet charge 0.75%. You're literally paying for nothing extra. Short track records, under 3 years, means no proof the strategy works across cycles. Here's a real example to drive it home. ARKK charged a premium, and since 2021, it's underperformed a lot versus VOO. That means you paid higher fees for worse results. Not good. If you want to know if you're overpaying, just do this quick audit every year. 3 steps. Find the ETF's expense ratio. Compare the 5-year return to an ETF that tracks the S&P 500's 5-year return, like VOO, for example. If the ETF return minus VOO return is higher than the ETF fee minus 0.03%, you're winning. If not, you're likely overpaying. Example, Chat returned 35% last year. VOO returned 26%. So if we apply the formula, difference equals 9%. Chat's fee premium equals 0.72%. 9% is way bigger than 0.72%, so it's worth it for that year. Make sure to check this yearly. If a fund stops outperforming, rotate back to VOO. Don't be loyal to underperformers. You'll just pay the fee for nothing. All right, before we wrap up, we need to talk about the part that most people skip, the risks, because every great investment comes with trade-offs. 1. Concentration risk. Here's something most investors don't realize. All 5 of these ETFs have some of the same big names at the top: NVIDIA, Microsoft, Google. So even though it looks like you're diversified across 5 different ETFs, you're actually betting on the same group of companies. That's called concentration risk. If those few tech giants stumble, all your ETFs will likely drop together. The fix? Add something different, like a small cap value ETF, such as AVUV, or an international ETF like VXUS. They move differently from US tech, which helps smooth out the ride. 2. Bear market behavior. Let's look at what happened during the 2022 market drop. SMH fell around 40%, SCHG dropped about 30%, and VOO, the plain S&P 500 ETF, was down only 18%. That's the trade-off. Higher returns mean steeper drops. So you've got to ask yourself, can I handle seeing my portfolio fall 35% without panic selling? If not, you might want to scale back your exposure to the high growth stuff. 3. Expense ratio reality. Next, let's talk about those fees. Some of these ETFs charge around 0.75% a year, and that can add up. Over 30 years, a 0.75% fee can cost you more than $50,000 on a $100,000 investment. So only pay that kind of fee if the fund consistently beats the index by at least 1% a year or more. And 4. Recency bias warning. And one last thing, don't get blinded by recency bias. These ETFs crushed it from 2020 to 2024 during one of the biggest tech booms ever. That doesn't mean they'll do 30% a year forever. Realistically, expect more like 12 to 18% annual returns over the long term. Still great, but grounded in reality. If you want to know what my top weekly ETFs are, make sure to watch this video next. I'm sure this will be super important if you're thinking about weekly dividends.